Thank you for having me. I really appreciate it. And hopefully our episode will be helpful for your listeners.
Yes, definitely. It's a pleasure to have you with us today. Why don't you give us a little bit of your background?
Sure. So my name is Jeremy Roll. I call myself a full-time passive cash flow investor. So I'm essentially a full-time limited partner or passive investor in syndications, which is essentially opportunities where a lot of investors are pooled together. I've been investing in passive alternative investments like real estate and some other asset classes as well since 2002. So it's been almost 20 years now. And I've kind of done that full time since 2007. My main focus is more predictable cash flow. I got out of the stock market after the dot-com crash, for those of you who remember all the way back then, because of the volatility and the lack of predictability of the stock market. That's what really bothered me about that strategy. So now I look for more predictable cash flow in both real estate and non-real estate assets. And I'm just a big kind of cash flow, more low risk person in terms of what I focus on. On the real estate side, I invest in both what I call commercial, which can include larger multifamily buildings, but all different types of, mobile home parks, self-storage, multifamily, student housing, multifamily, RV parks, industrial, office, retail. I also do some single family investing, all different types, lending to flippers, flipping homes, buy and holds, all kinds of stuff. And then I'm also involved in cash flow in various different non-real estate type of investments and assets, as well as a small handful of startups. So I also am I have a licensed real estate broker in California, but only for investing purposes. I've never done anything retail. I spent over 10 years in the corporate world before leaving. So my last two jobs were, for example, at Toyota headquarters, which was when I was there back in 2007 in Los Angeles. Also Disney headquarters, just as an example. I have an MBA from the Wharton School or University of Pennsylvania. And I'm originally from Montreal, Canada. I'm just a couple more things. I manage a private investor group of over 1,000 investors who are looking for similar opportunities to me, passive, relatively low risk cash flow. And I co-founder of a nonprofit called For Investors by Investors here in Southern California, which is essentially the solution to how do we network with each other without any sales pitch and open environments to discuss real estate. So we're the largest series of non-institutional real estate meetings in Southern California with over 30,000 members. And I'm also an advisor for Realty Mogul, one of the largest real estate crowdfunding websites. I've been with them since before they launched in 2012. I think I'm their only advisor who wasn't also an investor. So I was with them since before they started. So that's sorry for a little long intro, but that's my background.
Yeah, it's a great background. Unfortunately, I still remember the dot-com bubble. So I fully understand why you had an off there. And that was one of my own reasons why I suddenly also shifted gears a little bit more. We have been investing in real estate already before that, but certainly the stock market was a little bit more of a focus of ours until that point too, and it was pretty painful, definitely, to say that. Another point you mentioned, you worked for Toyota at the headquarters. Now I live 10 minutes from their new US headquarters. Here, I live in Frisco, and they have their headquarters in Plano, right? That is, I think, is one of the big stories that we hear over and over the last few years, where more companies move out of California into Texas, right? So obviously, Toyota was one of these big stories. Elon Musk with Tesla and many of his other ventures moving to Austin and the broader Texas area. So we certainly have seen a shift there. And it's interesting, obviously for you, you live in California. I assume that you still do some investment activity in California too, but I would suspect that a big chunk of your investments are actually outside of California. Would that be a correct statement?
Yeah, that's actually true. The vast majority of my investments have been and continue to be outside of California. I rarely invest in California because I focus on cash flow. And one of the challenges I have with California as on average is that the cap rates tend to be lower, which means that the cash flow is lower. And for me, on average, I'd rather be in a higher cash flow market. Still a strong market, but so I'm not really investing for appreciation as much as cash flow typically. So I'm almost exclusively investing outside of California. Coincidentally, I'm actually about to invest in an apartment building in Plano. So there we go.
Yeah, very good. So when we look back over a couple of years, and we have had the discussion already several years ago, right, where you and I, we were on a panel and we talked about kind of the getting already in frothy territory. And now we look back over the last year and a half since COVID-19 hit, and we are even in a crazier environment. So how are you handling this as a passive investor? Obviously, you need to pick the right sponsors, you need to pick the right markets and the right properties. But from a broader macro perspective, how do you see the world where all that stimulus money in a way has kicked that can further down that road?
Yeah, well, we're no doubt in very unique times and very interesting times, but also very difficult from a predictability standpoint, in my opinion, right? Both as far as not knowing what stimulus there will or won't be from the government in the future, which can impact the markets dramatically, and also just pandemic and other related things that are hard to predict going forward. Let me rewind a little and say that, if you look at what's happened this cycle, and in fact, I'll go even further back in the past cycle, because I was investing since 2002 in these types of things. Between 05 and 08, I was on the sidelines, kind of what I call end of cycle timing, high valuations, et cetera. And it was a very long time of waiting, but it proved to be, a good idea. And I have been on the sidelines mostly since the end of 2016, because if you look at this cycle from a regular cycle timing and historical length of average cycles, in my opinion, most of the asset classes by the end of 2000s were very expensive. And so I was only investing unique opportunities. In 2018, I believe, President Trump added some additional stimulus where normally in that part of the cycle that wouldn't have been customary. That kind of kicked the can down the road of creating actually a record long cycle. So that was kind of unpredictable, point number one that extended the cycle. Then, if you looked at what was going on, the yield curve was inverted and predicted the midpoint of prediction of a recession was actually in March of 2020, ironically, which is when we started to get lockdowns here, completely independent of each other. And so we were heading directly into a recession at that point where we had the pandemic. And as we all know, what happened during the pandemic is that the government's printed unprecedented amounts of stimulus dollars, and that kicked the can down the road and made an artificial environment of putting money in people's pockets to spend that otherwise wouldn't have been there. So that created probably a record short, what is considered to be a recession, which is kind of very odd to me that was considered a recession for the amount of time that it was, and put us in a position where the can again has been kicked down the road. So as a conservative passive investor, I like to have a macro strategy for a cycle. And so what I tend to do, because I can invest across many asset classes, and what I did, let's say from 2009 till now, is I had certain cash flow targets, and whatever asset classes that worked for at the time that I believed in the right areas with the right sponsors, I went for. And then as we got through to 2016, I would drop off of an asset class that I thought got too expensive, because they all had different pricing at different times for a whole different market forces and all the reasons. And then at the end of 2016, for example, they were all too expensive to me. And the last bastion, which was mobile home parks, the last everyone was chasing yield on, was then too expensive, in my opinion. So what I tend to do is set a cash flow target for a cycle and try to stick to it. And that's how I know if something's getting too expensive for me throughout a cycle, just to be more disciplined. My concern right now is that I can't tell, because I don't think anyone knows, whether the cycle is already finished and a new one has started, or whether it actually hasn't finished yet and we haven't seen a reset yet. And so because I'm really conservative, what I'm doing right now, to answer your question, is I'm waiting. I'm waiting now that the stimulus is waning. I'm waiting now that the eviction moratoriums are waning and finishing, and now that more foreclosure forbearances are waning. I'm waiting to see what does everything look like without the artificial stimulus that's been extending everything. And under the assumption that there won't be an additional short-term artificial stimulus, the infrastructure bill we're waiting on right now to get finalized and everything else, that is long-term stimulus. That is not the same as pandemic stimulus. It's almost the exact opposite. these are 10-year type of spending measures that they're talking about employing a lot of money, but only 10-year measures, not 1-year measures or immediate measures like we had in the pandemic. So it's going to have a very different effect and not the same short-term effect. So I'm waiting for a lot of the artificial stuff to be gone and to determine, okay, artificial stuff's gone. Are we going to have a reset? Are we going to have a change in cap rates? Are we going to have a change in asset prices? Because I'm a conservative investor who doesn't invest for major value add, and therefore I can't afford to invest at the wrong valuation. So I'm waiting, going to see what happens. And once I can determine if there's been an adjustment, but once I'm personally convinced that we've seen the writing on the wall after the stimulus is lifted and gone, then I'll start to jump in and reevaluate what do I the new cash flow targets, what does the new cycle look like, and begin to invest into a new cycle. And so, sorry for the long answer, but that's philosophically what I'm doing. Now, I've taken very specific steps and pivoted in different ways to still make sense of investing today with the current challenges, because even though I'm on the sidelines philosophically, there's always unique opportunities. I'm still making investments, but the volume of investments is much smaller, and they may be different types of investments that I would prefer to make, in a normal, regular time in the cycle. So does that all make sense?
Yeah, absolutely. So I would say, to summarize it, it has made your investment search even more difficult than ever, right?
Yeah, because we're lacking in predictability. Well, we're lacking in even discovery of an end of a cycle, and all these things for someone like me who likes to have as much predictability as possible is just clouding everything. And so what do I do when I'm uncertain and there's a lack of predictability? I wait, right? That's what I do as a personality for the most part. I still do unique things, but so the question is, then what do you do in the meantime to make sense of this and take what you think is good risk reward, because you can't go into your really favorite deal like me is having a experienced sponsor, diversified tenant base, larger apartment building, for example, or mobile home park as some stable type of cash flow asset that doesn't necessarily exist today in my world because of valuation concern,
Yeah, that's the big challenge, right? If you want to find that unicorn, it just doesn't exist, right?
Well, there have been, I found some unique things which are very hard to find that help mitigate the possibility of either downside risk in the economy or downside risk in asset classes. Some of it's real estate, some is non-real estate. But you're right, it's very challenging right now.
Mm-hmm. Now, on the real estate side, you mentioned mobile home parks. Obviously, their cap rates came down tremendously, right? Self-storage, another darling, right? Cap rates came down. So it's really hard to find any real estate asset classes that still make sense. So here, considering that you're looking for opportunities, obviously hospitality has been battered, right, due to COVID. Have you looked at it, and if so, have you seen some potential opportunities there? I know you're looking for cash flow, right? But I think even in a battered hospitality asset, if the price is right, with low occupancy rates and low ADRs at some point and RevPARs at some point, your cash flow is still strong enough that you could make an argument that it's the right time to step back in.
Yeah, 100%. So theoretically, your philosophy makes a lot of sense to me in terms of position I'm in. Practically speaking, I've always had a challenge with hospitality and a couple other asset classes, and specifically the ADRs, the average daily rates, they fluctuate every day. So if you're looking for predictability like me, that's a challenge because it literally changes every single day, right? You're not locking in 1-year rent or 5-year rent in an office space or whatever it is. So I think that I actually have looked recently kind of on the fringes and been studying it a little bit more. I looked at an extended stay type of unit, which had a little bit more predictability of cash flows. I ended up passing on that one. And the reason why is because I'm still concerned about valuations. So from a income perspective, yes, you can argue that if income's down, but the multiple is high, you're still kind of ahead of the game, right? In terms of the price you're paying. But I'm concerned that it's not clear to me where that path is going, how much demand is going to be available in the future on some of the, depending on the location and the type of use and what most of the traffic was actually, whether it was corporate business or travel, personal travel or both, that's hard to predict. But I am concerned that cap rates haven't adjusted enough to my liking in that space to merit taking on the additional risk of the lack of predictability of concern that I have. But that may eventually change. So I'm going to reevaluate that too, depending on what happens here in the next 6 to 12 months.
Yeah, interesting point. I think when it comes to the limited service and economy hospitality assets, another challenge we have been seeing it that you have a lot of multifamily investors that are now buying those up with the intent to convert them into multifamily properties, and we have seen some of the prices that these multifamily investors are willing to pay is well above of what any hospitality investor would be willing to pay.
Yes, and therein lies part of the problem, because frankly, I've seen some of those deals, right? And yeah, and you know, it's funny because the typical size of a little studio or one bedroom, you know, room in a hotel room is not the same as a typical apartment building. And I don't know what they're going to do with them or how they're reconfiguring them or not, but that's also a challenge. They're actually more pre-configured in many ways to senior living, right? Because the size of the space is right. It's got it's a separate shower in each unit that's probably in the right place. There's some Disability Act challenges with that, and some reconfigurations that take place. There's often like a common kitchen downstairs, so they can work really well for those, but it's still back to the same problem. People are paying a lot of money for these right now, and that's my primary concern.
Yeah, yeah. So are you looking at, with all that stimulus money and keeping interest rates low, so credit is flowing left and right, are you concerned about inflation, and are you looking to invest in other asset classes that are other than real estate that are potentially an inflation hedge?
Yeah, so I have two major concerns in the short and long term, frankly. They're both kind of intertwined. One is low GDP growth going forward due to the debt overhang that's only getting worse. And that's something that I've been talking about for 10, 20 years. We're falling on what I believe is a path like Japan. We're going to have, in my opinion, and I actually wrote a piece to my investor group earlier this year, I'm concerned that the GDP potential over the next decade into the next cycle, we're going to have on average is maybe 1 to 2% annualized. That's a big problem, because if we have 1 to 2% GDP growth, even if we don't have major inflation that everyone's talking about right now long term, but we have 3% inflation, you're now outpacing inflation on growth, which means that inflation is going to outpace incomes and other things. That is a big problem, big problem for many reasons, right? So, and it's also a problem for real estate investors, because as we have low interest rates and low returns, you may be getting outpaced by inflation. And of course, we can have an entire discussion about published inflation versus real inflation, right? And I would point people to shadowstats.com, fantastic website I'm not sure if you're familiar with, that publishes how the government used different ways of measuring inflation, because they've been adjusted by the government over time. I think that the most common favorite one is pre-1982 calculation, before the government changed it back then. At that point, if you look at it that way, we're at 8% inflation today, right? That's the way the government used to calculate it. It's not like some third party telling you to calculate. It's actually the way the government used to calculate it. And if you're a real estate investor or any investor, and you cannot hit that 8% cash flow mark, as an example, which is very hard to do today, and which I think is going to get even harder going forward because of what I just mentioned, that's really becoming a challenging situation. So I'm very concerned about that long term. I am actually not crazily concerned about the short-term inflation outlook, because I think it eventually will subside. I'm more concerned about it outpacing on average over the next 10 years, the growth itself. I'm more concerned about growth than inflation. But they do play off each other. Yep. I'm not necessarily targeting non-real estate assets as a result of the inflation. So what I've been doing in the last few years, I've been concerned about asset prices, and I've been concerned about adjustment in asset prices. So for me, the solution to what makes sense right now is where can I invest where I'm not as concerned about asset price adjustment, or I don't have to be worried at all about an adjustment. And if you want, I can give you a couple examples, but that's what I've really been targeting.
Okay, yeah. Tell us about those examples.
Sure. Well, let me give you some examples. So the most obvious one I think most people can understand is I actually went about 2.5 times higher. I do hard money lending each year, just as one of my, I do many different things. So diversification. So hard money lending is lending to people who are flipping homes, right? And you're in first position on a loan. Well, the supply demand characteristics of the market this year, I went 2.5 times larger than I normally do. I just went full force into it because it was just obvious. It was a great risk reward for investors, right? Where I didn't have to worry about asset prices declining because of the risk reward ratio, the supply demand imbalance that was happening. It was just obvious. So that was one thing I did. And that's a short-term play. So now I'm not worried about a long-term adjustment in asset prices that can really hit me down the road on the loan. This is a whole short-term strategy. I just went harder on that this year. Another example is I invest in ATMs. So ATM machines, the private ones that, you pay $3 or $4 surcharge. I get a portion of that surcharge as a passive investor. I completely stopped my investing once we had the pandemic retail closures because that's a huge risk to that in terms of transaction volume. But as soon as we had an approved vaccine that was starting to get rolled out and it was starting to be taken by the public, I knew we were likely at the trough of transaction volume and the risk was going to be removed. But more importantly, not only am I not concerned about the predictability of transaction levels going forward, now the retail's back open, but I know that those machines depreciate to close to zero. They're electronic. There's a case, there's a screen, there's a bill feeder, and I expect them to go to zero. So I don't care if they accelerate in their depreciation or not. What I care about is predictability of cash flow to make sense of that investment. So if we have an adjustment in cap rates, interest rates, whatever, none of that matters in ATM world, right? So it's all about the cash flow and the business continuing and the transactions continuing. Another great example of what I'm confident doing today, while I am very much concerned and not at all comfortable with where asset prices are going to be in 12 months. This is an example. On the multifamily investing side, very difficult to find unique opportunities today, as you can imagine and know. I won't do market rate deal for many reasons. I'm just not comfortable with it. But I've been investing in a number this year alone of either tax abatement or low-income housing tax credit deals. Those deals are designed both to provide cushion at closing in many cases, but also to have mitigation risk on potential adjustment downwards in both asset prices and in rents and NOI. And so that's been a defensive move, but still makes sense, I think. And there's very unique situations. I can give you the details, but you just build up on the tax abatement side, you can build up a tremendous amount of value between putting it under contract and closing that just mitigates huge downside risk with no execution risk. So, and there's other examples too of stuff that I've been doing, but you could see for me, it's either got to be a unique situation, create some padding at closing with no operational risk, or I don't have to worry at all about the actual asset prices, be it because it's short-term hard money lending with good supply demand characteristics, or an asset where I don't care if it goes to zero because it's already going to zero, right? So that's been my pivots, right? This is not the way I like to invest normally. I want to be in the long-term, more predictable, large apartment building or mobile home park with more predictable cash flows, but that's not what exists today. So you kind of got to pivot and do what makes sense.
Yeah, that pivoting is absolutely crucial, right? To position yourself and be ready once you have that predictability back in play, right?
Yes. And I will also say I've been pushing my sponsors to sell since the end of 2016. I've been involved in probably at least 40 sales since 2017 because I'm hyper diversified. I know over 60 LLCs right now. It's just what I do. I get because I'm just doing this full time. And so I still, even today, I'm pushing to try to take some money off the table and certain things. I'm actually involved in a very big self-storage portfolio closing, hopefully a sale that's going to close in a couple of weeks, which I'm still very happy to be locking in these rates. And pushing a very large mobile home park sponsor I've invested with to try to sell either all or some of the very large portfolio, and probably going to sell some stuff. So, at today's cap rates, it's just so enticing to lock in some of these prices.
Yeah. Naturally, you will have some sponsors that will argue that because interest rates will stay low, cap rates will stay low, or go even further down, right?
Yes.
I think and you have been in that business long enough, we should always remember that in 2009 and 2010, even though interest rates came down, cap rates moved up, including multifamily and all the other asset classes. So it can go, even though interest rates can come down, cap rates can go up.
I couldn't stress that enough. I 100% agree with you. And interest rates are one component that affect the cap rates, but it's only one component. I think people underestimate consumer sentiment and concern in the market, and how that can shift the amount of liquidity that's in the market very quickly, the amount of the multiple or the cap rate that an investor is willing to pay. And I'll tell you one other thing that a lot of people I think are not considering, and it's critical. At these low cap rates today, a small shift in cap rates in the wrong direction has a magnified effect on the price. If we take it back to 2009, there's literally 2x the magnification right now on a shift in cap. So 100 basis points today is twice the impact that 100 basis points was back then because cap rates were double. Okay,
Absolutely, yeah. The
and
percentage impact is much bigger. Right?
Exactly. So the risk on investors is literally 2x as far as a price swing. And by the way, the benefit's also 2x, right? So there's the other side of the table where you can benefit by cap rates compressing much more quickly. And so, but if you're concerned about risk like I am, because I'm a low risk investor, that's another reason to sit on the sidelines and just wait to see what happens once this artificial stuff's gone, and then go back in when you think that the adjustment is behind us. Whatever, maybe there won't even be an adjustment, but at least have the comfort level that we know that there won't be an adjustment.
Right. Yeah. So that's a very good point, right? That you are comfortable, right? Yes, you may have missed out, right? But at least you now know where you are starting out again and are comfortable with it. I think also one thing that when we talk about cap rates and that it only goes in one direction because it's so much liquidity, and we have seen that, and you know that too, right? We see that in traded assets too, like stocks and bonds. Yes. You have that the impact of asset allocation, right? So now everyone has moved a significant amount of money into multifamily and other darlings in like industrial, in commercial real estate, but at some point that reallocation has taken place. So then that ongoing liquidity stream will slow down at some point, or will actually reverse. Right?
Yeah, I agree. And a couple of things people aren't considering either. We have record high margin levels right now against stock portfolios. A lot of that is actually going into these assets and going into crowdfunding and also going into Bitcoin. Yeah. And I think a lot of people underestimate the impact of margin calls and reductions in margin on the amount of liquidity available, and frankly, even some forced sales that can then spiral against itself and get bigger. And so, yeah, I think you make a really good point about the rotation of money and where it's going and where it is today. I can't say enough about how popular multifamily has been in the last 2-3 years from what I've seen. It's typically very popular because if you think about in an average city, there's many more apartment buildings than there are self-storage units, for example, or even mobile home parks. So there's just a lot more availability. You see more of it. But investors seem to have gotten really very exuberant about that asset class. I happen to love the asset class in general, but there just seems to be a outweighed amount of money that's gone into that in the last 3 years at least.
Yeah, I think we all agree it's a great asset class, right? Yes. And long term, there is no doubt that it's one of the best real estate investments that one can consider. But there will be corrections at some point, right? And one needs to be prepared for it, right? And so your approach of finding investments is great. So Jeremy, I think really appreciate you spending time with me today. You're a wealth of knowledge. You're also, I think, particularly when it comes to passive investors, you're really the person to know, so that the passive investor can get some guidance, right, in this crazy world of alternative asset investing. And so how can passive investors and other investors reach out to you?
Yes, and I should have said at the beginning, and I'm not a financial advisor and investment advisor, so I'm just anything I'm sharing today and in general, just my perspective as an investor. But I'm always happy to help brainstorm and network. And anyone who wants to contact me, other investors who want to brainstorm, even if you're new and just curious to learn about how this works, other sponsors who are looking for investors, or even investor groups who want to network with me, anybody is welcome to contact me. The best way to reach me is through my email, which is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com.
Yeah, thank you very much, Jeremy. And I cannot stress it enough how important it is to talk to individuals like Jeremy and many others when one is investigating potential investments, right? And again, it's not about anyone peddling any type of investment. It's really just more about the process. How do I identify the right sponsors? How do I identify markets? How can I trust the sponsor? How can I trust their underwriting? What direction should I go? And the more you talk to individuals that have done it for a very long time, like Jeremy, the more valuable that information obviously is for someone who has not done that for that many years. So again, Jeremy, really appreciate your time today, and good luck hunting for these investments. I know it's really tough for you as well as for all the other investors, but it's good to hear that you're still successful finding these nuggets out in the dark. So thanks again for coming on.
Yeah, absolutely. No, thanks for having me on. I hope this is helpful for all the listeners. And I want to repeat one thing we've talked about on this podcast, which is very important. In 2005, 2008, I was just so frustrated sitting on the sidelines, and it's a long 3 years. And now it's been a very long 4, almost 5 years for me. But, I would caution everybody the following, and I tell everybody, a lot of people come up to me today and say, I'm going to invest in this. Cap rate doesn't matter. Interest rates are going to continue to be low, et cetera. I ask one important question. Do you believe that cycles are no longer in existence? Because if you do, no problem. Like, the outlook for 10 years is fine. If you don't, and you agree that cycles still exist, then make sure you formulate your own opinion as to what is going on with this current cycle that's a record long cycle that may or may not have finished, because that really should partially dictate what your decision making at this point. And if you're looking at a 5 or 10 year deal, that's a long time from now. So, just think of it, forget the short term. Think about the idea of cycles, and do you think there is going to be an adjustment or not, because cycles still exist or they don't? That's the one thing I would leave you with today that I think is important to keep in mind.
Yeah, very wise words. Thank you very much, Jeremy.
Yeah, thanks for having me.
Thank you.